Hey everybody, in today's video we're going to be taking a look at Rivian. I'm going to be starting off with the company's stock, and then we're going to move on to their products and services, and then later on we're going to be going over their financial statements. Looking at the stock, you'll see it has come down quite a lot from where it was a year ago, although it did jump up a bit more over the past month or so. It's trading for $21.56 per share right now at a market cap just over $20 billion. Their price to sales ratio is 6.73 and a price to book of 1.75. But Rivian is not profitable at the moment, so there's no price to earnings ratios. Of course, they do plan on becoming profitable in the future, but it's probably not going to be several years until that happens. Moving on to their products, Rivian currently offers two consumer vehicle models. One of them is this pickup truck right here called the R1T, and then the other is this SUV called the R1S. Now you might notice that between these two vehicles there's a lot of similarities in their design, and that's because they are built on the same platform. So these two vehicles share a lot of the same parts, which is one of the ways Rivian drives some of the cost efficiencies for these two vehicles. So the first of these R1 vehicles Rivian began delivering was the R1T. They began delivering them in late 2021, although there was a very limited number of units that were actually delivered to customers at that time. So things really started to get off the ground later on, in 2022, once their production facilities were able to produce more vehicles. So things have really picked up for Rivian since they began the deliveries of the R1T. And now they have actually shifted a lot of their production over to the R1S. In the second quarter this year, the R1S comprised about 70% of Rivian's production, and this was the first quarter that Rivian was producing more R1Ss than R1Ts. And this massive jump was really due to their massive backlog that they had for the R1S. It is a very popular model, and they've said in the long run they expect most of their vehicles that they produce to be R1Ss at about 70% of their R1 production, and then about the rest, the other 30% to be R1Ts. Moving forward for the rest of the year, Rivian is continuing to shift their production more towards the R1S, and they're doing this to address the large backlog they have for this model. They've been producing R1Ts for a longer period of time, so they've been able to keep up with that demand a bit better than the R1S, which I believe only began deliveries earlier this year. So they really just have a lot of people that want an R1S. The wait times are very long for both of these models, but the R1S, I believe, is even longer. So in order to keep up with that, they're shifting more of their production in the short run towards the R1S. But eventually, as time goes on, they will begin to shift that back towards the R1T a bit. And eventually, of course, in the long run, expect to be producing about 70% R1T and about 30% R1S as far as their R1 vehicle models go. Now, in addition to the R1 vehicles Rivian offers for consumers, they've also got a commercial electric delivery van, and right now they've got an exclusivity agreement with Amazon. So Amazon is the only customer of this at the moment. That's why you see all of this Amazon branding all over this thing. But eventually, this contract is going to come to an end, and Rivian will be able to sell this product to more customers other than Amazon. Under this agreement, Rivian is supposed to deliver 100,000 of these vans to Amazon by 2030, but it seems like Amazon has kind of been chickening out on ordering too many more of these things, which is part of the reason Rivian is trying to terminate that exclusivity agreement a bit earlier than they were originally agreeing upon. Because Amazon just isn't putting in too many orders for these things. So, the demand could be a lot higher if there was just more customers that were able to purchase this thing. So that's kind of what Rivian is kind of trying to do here. So we'll see how all of that ends up turning out. All of Rivian's vehicle production today comes from their factory in Normal, Illinois, but they are working on getting a second factory up and running in Georgia. Rivian is also building out their Adventure Network, which is their own charging network of DC fast chargers, similar to Tesla's supercharging network. They're planning to build over 3,500 of these chargers at approximately 600 sites in the US and Canada. And DC fast chargers are not cheap to build or install, so it's going to take Rivian a lot of time and a lot of money to build out this Adventure Network. Of course, this was kind of something they did before Tesla opened up their superchargers to other automakers. So that's pretty much one of the main reasons why this exists. Rivian also offers insurance for their vehicles, similar to what Tesla is doing. But they say you can also cover your home, boat, camper, and other vehicles through Rivian Insurance. And there's a couple other differences as well compared to Tesla's. One of those is that Rivian is not underwriting their own insurance policies at the moment, whereas Tesla is now. Tesla started off this way, where they would outsource it to third parties, but as of, I believe, last year, Tesla started underwriting their own policies, but Rivian is still outsourcing it to third parties. Currently, it seems like those would be nationwide, and then the Cincinnati Insurance Company or one of their subsidiaries. And on their latest earnings call, they said their insurance business is profitable today and that the attach rate is quite high, so it sounds like this is going pretty well for Rivian so far. Another thing that ties into this is Rivian's network of certified collision centers. These are third-party locations that have the necessary tooling and have trained their staff to work on Rivian vehicles, but Rivian is not the owner of those locations. If you compare this to Tesla, Tesla also has some certified collision centers, but they've also got a lot of ones that they own themselves. So that's just kind of how it compares between these two companies, Tesla and Rivian. Another part of Rivian's business that was brought up during the Q&A segment of their earnings call is their gear shop. Over here, they've got all sorts of merchandise, but then they've also got a lot of vehicle accessories as well. They also mentioned they could shift some of the costs away from their core vehicle and over to some of this gear, and that way they could achieve a base vehicle with a very impressive cost structure and probably a lower starting price, and make up some of that revenue by selling some of these accessories. Some of these things are very integrated with the vehicles, like this flashlight right here. This thing perfectly slides into this door, and this thing is $175. So I'm sure that thing probably has a pretty good profit margin for Rivian. So that's one of the things they're thinking about for the future. Moving on to Rivian's financials, I've got their income statement from the second quarter this year pulled up, and you'll see their revenues have jumped very substantially over the past year. Right now, they're just over $1.1 billion in revenue. Last year, only at $364 million. Right below that, you'll also see their cost of revenues, just over $1.5 billion. These are up about 50% over the past year, so currently, they are still not making a gross profit on their vehicles, but those margins are going up very quickly. You'll notice, even though this was a 50% jump, they had like a 207% jump in their revenues, so their gross margins are going up very quickly. There's a few things driving these margin improvements. One of those is that the raw materials used in the vehicles are coming down in price. And then another thing is that they're renegotiating some of their previous contracts with some of their parts suppliers to try and get those things at better prices than they had previously agreed upon in the past. And then another thing is that they're simply building more vehicles. They're producing at a larger scale. So some of those overhead costs per unit are coming down pretty rapidly as they continue building more and more vehicles. Their research and development expenses declined over the past year. Right now, those are at $444 million. And then their selling, general, and administrative expenses also declined a bit. Right now, those are at $429 million. So all of that gave Rivian an operating loss a bit under $1.3 billion. They also had interest income of $141 million and interest expense of $54 million. So that brought their net loss back up a bit to just under $1.2 billion, and then net loss per share at $1.27. Moving on to their balance sheet, we see cash and cash equivalents of $9.3 billion. This has been declining over time as they continue to ramp their production. They have also purchased some short-term investments with some of that cash. Those are sitting at $942 million right now. Their accounts receivable is at $342 million. Inventory currently at $2.16 billion. And then other current assets are at $156 million. They've also added about $103 million to their property, plant, and equipment over the past year. Right now, that's sitting at $3.86 billion. Operating lease assets were at $325 million, and other non-current assets were at $180 million. So their total assets at the end of the second quarter this year were at $17.2 billion. Moving on to their liabilities, they've got accounts payable just over $1 billion, accrued liabilities at $943 million, and then the current portion of their lease liabilities and other current liabilities are at $324 million. Then the non-current portion of their long-term debt is at $2.7 billion. Non-current lease liabilities are at $305 million, and then other non-current liabilities are at $216 million. So overall, Rivian has total liabilities of $5.5 billion. Subtracting those total liabilities from their total assets, you'll see Rivian has a book value of about $11.7 billion. Now, there's a few more things I think I forgot to mention earlier. One of those involves the profitability of the R1T compared to the R1S. They said that the R1S is more profitable than the R1T right now, and I think the main reason for that is just because it has a slightly higher selling price. They did also mention during the earnings call that the production efficiency of the R1S is almost, if not at the same level as the R1T. So it sounds like the cost efficiency of building the R1S to the R1T is pretty much the same right now. So it seems like that increased profitability of the R1S is pretty much driven by the slightly higher selling price of the vehicle. They're also planning to shut down the production lines of the R1T and R1S sometime in the middle of 2024. This is to raise the capacity that they're able to produce with those lines from around 65,000 units per year up to around 85,000 units per year, and incorporate new technology into those lines as well, possibly also adding new technology to the vehicles those lines are producing. Earlier this year, they temporarily shut down the production of their electric delivery van. In that time, they incorporated a lithium iron phosphate battery pack. They also incorporated their new Enduro drive motors that they're building themselves instead of ordering from suppliers. Those are also being introduced into the R1 vehicles. Right now, I believe those are only in the dual motor vehicles that they just started offering earlier this year. The quad motor vehicles are still using some of those motors from suppliers, but over time, eventually they're going to be incorporating those Enduro drive motors that they're producing themselves into those quad motor variants. But anyway, that temporary production shutdown for the electric delivery van resulted in an about 35% reduction for the material costs in the product, and they've said that they're expecting a similar reduction in material costs for the R1T and R1S once they have their production shut down in the middle of 2024. They were also asked about potential price cuts for their vehicles. They said they believe the demand is still pretty strong. They said they were looking at some of the used Rivians out on the market and seeing that they haven't depreciated in value very much, so that signaled to them that the demand is still strong for their vehicles, and it doesn't sound like they're going to be cutting the prices in the near future here. Another thing is that Rivian believes they have enough cash on their balance sheet to continue their operations through 2025. Somebody in the Q&A segment of the earnings call asked about a capital raise sometime in the future and what the timing might be for that, whether that would happen sooner or happen closer to 2025 perhaps. Rivian kind of dodged the question. They just said that they're continuing to evaluate the circumstances and didn't really give a very definitive answer at all. Rivian is also working on a new consumer vehicle platform called R2. This would be kind of a lower priced version of the R1 vehicles. So presumably there would be an R2T and an R2S. And these would kind of be like lower priced, smaller form factor versions, cheaper to produce than the R1 vehicles. They're planning to show the R2 vehicles for the first time in early 2024, but they're not planning to launch them until 2026, so it's still going to be some time until those are on the road. But that's pretty much it for Rivian. I hope everybody enjoyed, and I'll see all of you in the next video.